So thank you everybody for sticking around to the last session of the day. It's been, hopefully everybody has found this to be an extremely valuable day. I think it was, pleasantly, I won't say totally surprising, but just looking at the really innovative ways that people are looking at using EigenLayer is it's exciting. I know that's what you intended. Sriram talked about that a year and a half ago, but it's terrific to see how many people are finding uses for it in different places. This panel, though, is in general alignment. I put it in the risk category, and thank you, Justin. That talk you just gave was a very healthy dose of realism. The devil in the details around something like this. Let me kick off this panel, though, and try to not be a moderator who talks too much. I've already failed at that. But if we could just do quick intros. So if everybody says their name, the protocol, and then maybe just so we can kind of portend if there's going to be some spicy disagreements, just say a number from 1 to 10, where 10 is alignment is likely going to be easy and work out well, or 1 being might work out well, but we've got some serious challenges ahead of us. Okay, start with somebody nobody knows in the room. Over here on my right.
Hi everybody, I'm Sriram. I work on the EigenLayer project. The alignment score, I would say maybe 7.
Ooh.
All right.
Wait, is high easy or high hard? I forget.
High is like very optimistic, positive, that everything's going to go well. And 1's not saying that you think it doesn't have a possible good outcome, but like it's a major concern, like first order concern about doing this new protocol mechanism.
Hey, so my name is Mark, and I'm a contributor to the Optimism Collective. I work on Optimism, and over a long enough time frame, I would definitely say 1. I think in the short frame, in a shorter time frame, we can kind of all trust each other because we know each other, right? But generations in the future, the stake is only going to grow. So definitely 1.
Ooh, full Eliza.
It's okay. We have concave and convex optimizers. And, if you're convex, then you're going to go 1 or 10, right?
Right. I'm Justin from the Ethereum Foundation research team. I guess I would say 2 or 3, kind of complement to 3RAM. But yeah, I agree. It depends on the time frame. Like in the short term, things will go better than in the long term. Yeah. But I'm hoping that there is path dependence, in the sense that we can plant a seed that puts us in the right direction, that is sustainable.
Mm-hmm.
Hey everyone, I'm Mike. I also work at the Ethereum Foundation, and I would say I would put it at a 3, with the caveat that I think alignment beyond just the consensus layer is super important too. And I think like in terms of an application getting too big, and like a layered view of decentralization is important, and kind of extending the discussion of alignment beyond just things that touch the core protocol is important too.
Mm-hmm. Mm-hmm. Okay, great. And so we have, just to recap, 7, 1, 2.5, just going to take an average single number, and 3. So so we actually, this could be pretty spicy. Sriram, sorry you're up here alone. We didn't, we definitely didn't, put a nice easy fan up here for you, so you could have some convincing to do. Let me pose one question here, which is, to what degree do people on the panel feel that the alignment is largely taken care of by people opting in to use the system? A lot of the discussion about like hardware and capital risk and others, that's kind of based on people wanting to actually restake. Nobody has to do it. For users on the other side and protocols, they have the option to do other staking. So just curious, maybe let's start with the people that are more on the negative side. How fundamentally does kind of opt-in, not take care of alignment on its own as like a price discovery, mechanism around the risk?
Right, yeah, I guess the the concern here, especially if you kind of have this permissionless incentive design space that we're in, is that an opt-in is just kind of a centralizing force. Like if in order to opt in you need high hardware requirements, like this is kind of circling back to Justin's talk, then like it's not really opt-in for everyone, in that everyone doesn't have the option of opting in. So I would say just letting it play out on the incentive level like doesn't seem like that would lead to good Ethereum alignment necessarily. It would be like incentive alignment for sure. But that would also be like highly centralizing and probably increasing the fragility of the overall system.
Okay.
Right. I mean, I'd say something similar, that show me the outcome, show me the incentives, I'll show you the outcomes. And like right now we're in a period of transitioning and discovery, and we don't really have like a true like cost of money. But eventually we'll have that, and then I do think there is this economic forcing function, as I mentioned in the talk, where if you're under the cost of money, then it's irrational for you to be staking. And it's possible that stake capping will be a kind of an accelerationist force towards this discovery of the cost of money. So the idea of stake capping is, in order to enforce a cap, for example, at 30 million ETH, as soon as you get close to the cap in terms of the amount of stake, the issuance goes negative. Now why would the issuance go negative? It would go negative because, let's say, negative 3%, because you can make 5% restaking, and so you kind of net 2% cost of money. And so you can't just sit back and relax if you have negative 3%. Like you either exit or you play the restaking game.
Mm-hmm.
In a really competitive ecosystem, the stakers that opt into the system, if they're able to make more, there is an economy of scale, and that's definitely a centralizing force, and that just compounds over time. Compounding returns. I feel like maybe it was like Warren Buffett or somebody said that compounding returns, or it was Albert Einstein, I think. Compounding returns is like one of the most powerful forces in the universe, right? So.
Oh, that's where Warren Buffett got it from. I know he definitely says that a lot. But
yeah.
Okay.
Totally. So yeah, it is very centralizing if entities are able to outcompete, and especially if they can pass this on like through a product to like users, like a higher yield.
Okay. All right. So we got a couple questions here, and I know Shriram, you talk about this as a, potentially positive thing that validators on Ethereum that have excess capacity can make more money, but I don't know. What's the eigenlayer view on the risk of raising the bar for people who can enjoy that benefit?
Yeah, it is definitely something we have to consider carefully. For example, this is one of the reasons we built EigenDA as the first use case, where the node requirements are even lower than that of Ethereum, while the system throughput can be larger because it's a horizontally scaling system. But the fact is, every staking application will not be like that. There will be applications that will demand more computational requirements, and they may lead to more centralization. To frame the risk discussion, I think it's worth starting with what the comparison or the alternative hypothesis is. Because otherwise, we are comparing risks of something versus something else. And I think, if you take a view that LSTs exist, liquid staking tokens exist, and DeFi exists, and there is non-zero return in DeFi, then already you have all the problems that are laid out on EigenLayer already exist pre-packaged in LSTs. Some of people assume that there's going to be so much of yield in restaking that everything changes. So the null hypothesis that we're operating under here, if we actually assume that it's true that restaking is going to be a centralizing force, the hypothesis is that the total restaking yield is much higher than the total DeFi yield. That is the operating assumption. Okay. It could be true, it could be false, but that's the assumption under which restaking even plays a role in this conversation, right? Of course, I'm from EigenLayer. I'm prone to be optimistic about what restaking yields will be. But even for people taking the opposite position, that seems to be the assumption. I don't know if it's going to be true because, and on the one side, there is a possibility for it to be true because the only thing that's different between, a non-crypto world and the crypto world is the presence of decentralized trust. And if decentralized trust is the only essential the essential essence, then maybe it's possible that supplying decentralized trust is of the highest value. But in that case, if decentralized trust is the highest unit of value, people will value decentralization along with just the presence of capital. And there will be additional rewards for, the kinds of home stakers and measures that actually measure decentralization and reward for it. So I think the premise is a little bit flawed. If decentralized trust is high value and therefore restaking is, going to have high rewards, then the market will automatically value decentralization because decentralized trust is what is being valued. So that's where I think, there's the dividing line here is if decentralized trust is what is bringing so much of value, even greater than DeFi, then maybe market will have the intelligence to value decentralization along with just the capital that goes with it. So that's our thesis. And we give expressive mechanisms in EigenLayer to actually value these things. And over time, hope that people will explore and build these things even better. So that's our view.
Okay. And I mean, yeah, it can be a somewhat expensive, painful process for broader people to learn and feel this. I think the DeFi collapse of 2022, based on people trusting too much in hidden centralized systems, has taught a lot of people what the decentralization maxis had said, which is you need to pay attention to who holds your keys and who has this hidden agenda potentially. I'm gonna, if it's okay, I know when I was listening to Justin, I was thinking there's so much to cover on the technical side that we could spend the whole time there, but I would feel a little remiss if I didn't talk about some alignment stuff that seems maybe less important, but because it's financial. But on the other hand, financial stuff in crypto tends to take importance as well. So, one of them is, and I don't know, maybe let's start with Sriram on this one, because he probably have a perspective that'll be useful for, optimism and EF to kind of comment on. And that's, there is an alignment that is happening throughout the blockchain space, which is that if some blockchain, the reason why people love L1s or a place where you have a token is that if there's a positive perception about the protocol and other things, you get this large increase in your token value, not based on revenue, but just based on community and other stuff. If we're at a point where restaking means that the core kind of security and needs for a token are largely gone, of course tokens will remain in protocols, but they're arguable going to be much more just based on revenue, kind of unit cost efficiency. And this could be enshrining as like a medium of exchange, Ethereum, even more than things like Bitcoin, because the slashing conditions are so much more flexible on Ethereum. So it's kind of a reshape. But certainly, between optimism and Ethereum, how do people feel about where value accrual may happen from a financial kind of, investor point of, will it be viable to have these accumulations? I mean, Sriram, you say it as a negative, but in the sense there's a bootstrapping cost. But once you finish the bootstrapping costs around the token in your ecosystem, you may have billions of dollars, and that might go away. Most of that value might go to Ethereum token if restaking is successful.
I think the answer that I would give is more nuanced. I think, protocols, so the question is, the way I would think about it is whether, using your own protocol token as staking is strictly positive sum or strictly positive or more value additive to your own protocol than to use, some aspect of security from restaking. And I think there is some value to adding something like restaking as in a dual quorum or whatever fashion, even if the protocol has enough economic security. Part of the reason here is due to things like security death spirals, where like as the protocol's token for whatever speculative reason goes down in value, then it becomes less secure, and as it becomes less secure, more users disconnect from the protocol, and more users disconnect from the protocol, people speculate it down further, and you could have these kind of death spirals. And borrowing some aspect of security from Ethereum, basically in a dual quorum model, for example, lets you cut the negative downside of the death spiral while maintaining some portion of the upside of the spiral. It's basically like you're paying a constant amount to insure against the death spiral. So that's one way of thinking about it. But in terms of whether like this actually promotes the moneyness and of Ethereum more, I think it does in actually ways that we hadn't even fully understood when we started. For example, one of the things we're doing with EigenLayer is insurance mechanisms where people can buy a portion of access to a portion of the slash funds. And because that's going to be denominated in ETH, what happens is imagine that you're trading some application, you're running a bridge or whatever, some other application where its liabilities are denominated in ETH. Then having the ability to buy, slashing insurance also denominated in ETH is actually like very much aligned, because if your liabilities are denominated in ETH and then you have to buy insurance in USD, then you have to factor in the cross volatility risk. Whereas if your liabilities, due to the already existing nature of like many NFT marketplaces and other things pricing in ETH, if your liabilities are already denominated in ETH, then might as well buy insurance in ETH, and EigenLayer actually gives you a mechanism to buy insurance in ETH. So this strengthens, in my view, actually the strong network effects of the moneyness of ETH already inherent. Yeah, so that's the starting point of my view.
Totally. So one thing is I definitely am not in the business of like giving financial advice or anything like that. So definitely not that. But I do think that like, thinking about crypto assets as like investments is important because, number go up is the ultimate alignment tool, right? No matter what culture you are, what culture you're a part of, what language you speak, when you both have something, you're holding on to an asset and number goes up, like you're aligned. So, that's all I can really comment on that topic.
Yeah, I would, just interesting comment, because like I have thought of number goes up. I've kind of put it another way that the belief that the number will go up is aligning. Once the number goes up, in some ways it could be disaligning, that you're setting up a bunch of people that have not taken in the gain of previously, and if you don't have, it's been said in the regular stock market of like any time the number goes up, the investors who are happy kind of exit and new investors come on who force the company to, basically give up any kind of ethics to get profit, to make them happy. That gets replaced by a new set. So it's like a never-ending accelerating treadmill. But yeah, definitely price action is very aligning.
Yeah, so the way that I think about value accrual and valuations is that there's two dynamics, right? On the one hand, you have the unit economics, as you said. You can think of Ethereum as a company and Ether as shares in that company, and there's like profit and loss. Like you have expenses paying for security, and you have income in the form of the burn. And I think, EigenLayer can help with the unit economics. It can help. So there's this thing called restaking burn, where you burn the proceeds of restaking, and that's basically what I described, which is the stake capping, where you have negative issuance to compensate for restaking proceeds. And also, just EigenLayer should just potentially dramatically increase the utility, and so transaction fees and activity should go up. I guess the other part of the mental model that I have is monetary premium. And here, a big part of it is credible neutrality. And roughly speaking, monetary premium is like an order of magnitude. It's like 10x on top of the raw utility. And so if Ethereum becomes, a machine that sells, let's say, $1 billion of block space per day, it might be valued like Apple, I don't know, like $3 or $4 trillion. And then on top of that, if it's like credibly neutral and it's kind of money for the internet, it could see a valuation of, I don't know, $30 or $40 trillion. Now, this 10x is actually very important because it provides it provides utility, right? Because it provides economic security, and it also provides economic bandwidth for things like decentralized stablecoins. And so one of the things that I'm a little bit worried about is that restaking kind of, even though it improves the unit economics, it lowers the credible neutrality because it kind of erodes the validator set, for example. And often people ask, and they're very puzzled, like, why is operator decentralization important? And there are like edge cases where it is important. For example, if the World War III were to break out and all the large operators were to go offline, it's kind of nice to have a small set of stakers that are still there to keep the system running and bootstrap. But that's not the most important reason. The most important reason is actually mimetic. It's a very good look to have a decentralized operator set. And that is a key to this 10x monetary premium, and it's a key to having very high economic security and very high economic bandwidth.
Mm-hmm. I think the only thing I wanted to add there is I think there's potential that EigenLayer could be used as like a bootstrapping mechanism for some protocols. And it's kind of like this thing where if you build an app, like a decentralized app, and it starts getting a lot of usage, you might want to turn it into its own chain. And maybe you start off as like an L2, like an OP stack chain or something. But then if you get enough usage and product market fit to be in a position where you think, why am I paying all this rent to Ethereum when I could just make my own L1 chain? Then there might be a situation where kind of EigenLayer sits in the middle there, and it's a mechanism to bootstrap the trust of the system and accumulate product market fit, only to then be used to take a huge set of users from Ethereum and move it somewhere else. I'm not sure how likely this scenario is, but it kind of came up as a scenario in my mind when thinking about how... Oh, Justin's getting a call.
Sorry, my wife, she's on like emergency mode. I'll go in plane mode, I guess, which overrides emergency mode.
If it's an emergency, you should take it.
Yeah, exactly.
She calls me every day, but it's still emergency mode because, she gets precedence over work.
That is alignment right there.
Wife alignment. Wife alignment.
So Ethereum aligned, he turns off the cell phone from his wife.
Yeah.
But yeah, that's just something that came to mind. Whereas like in the short term, the kind of value accrual and monetary properties of Ethereum are improved, only to be like step function decreased by a large portion, or a large application like becoming its own independent L1 and competing directly with Ethereum.
Mm-hmm. Okay.
But that kind of dynamic can already exist. You can be an application on Ethereum and then become big, and then or be an OP stack, roll up, and then go out. I think the thing that holds everything together is everybody is there, so you want to be there. So the more likelihood we give for more applications to live and interoperate and share security, share assets, I think the better it is.
Yeah, yeah. And I asked the question very much as like making it look like it's one or the other, but if people were in for some of the talks today, people discussed about kind of hybrid dual token models for security, because what Sriram was saying about, there's a good aspect to avoiding kind of death spirals in having, a completely new token for security, but you don't necessarily need to get rid of it entirely. You can do something in the middle and then kind of get the security improvement without, giving up your own upside completely. So trade-off space, which is good. Everybody, technical loves trade-off spaces. Another kind of flip side, which, I appreciate, you made a good point that, I'm introducing financial stuff. It's always a little bit, everything that we say here, especially with financial, is completely unknown because everybody has the same information. It's all kind of public information. There's no privileged knowledge here. Everybody's just kind of guessing on what, how things may play out. On that, one thing that I don't think anybody here's kind of talked about, but in talks, but I see come up a lot of people do try to look at different things that you will end up doing with ETH, and the categories. One category that split that's been coming up has been staking. Another is MEV. I haven't seen people put it as, but there's the kind of exiting from that space and getting some kind of yield, and then now there's restaking. And people are making predictions about potentially things changing a lot. Does it fundamentally change if one of these becomes a lot more significant? Like early in the MEV days, there were people who kind of were predicting MEV is going to be 5 times more. Regular staking is going to give you, let's say, a 2% return long term, and MEV would do 6%. And there's a lot of worry about that. Now there's some people that actually feel like MEV is probably trending more towards 0, or at least it's going to end up getting apportioned out to different pieces and kind of go to the value around parts of the system that are in the transaction. So some people feel like restaking may actually end up being large returns, 6, 10, 15, like high amounts that people are going to get from it. One, do people think people always get too hyped and don't even pay attention to it because nobody knows? Or, two, assuming just hypothetically that that's the case, does that cause alignment problems to have, a a layered on top of L1 protocol that would be vastly exceeding the, the return of, the layer 1 protocol's yield on the token? So let's go to Justin.
I mean, one of the very nice things about the incentive at layer 1 is that they can be perfectly engineered to be whatever we want. Yeah. And 2 very important properties is fairness and lack of volatility. And MEV kind of threw a wrench in this because it added volatility in the reward. Turns out that I think there's going to be a solved problem, partially because, as you said, MEV is going to 0, but there's this other solution as well, which is MEV burn, which basically removes the volatility to a very large extent of MEV. Unfortunately, for restaking, I don't know how to make it equal access and fair, and I also don't know, with restaking, I don't know how to make it low volatility. And so, one of the research, directions is I guess restaking smoothing. How do you do that? Yeah, and I have no idea.
Yeah, I mean, you're one of the most optimistic people on how well people are able to technically solve problems, and sometimes when I've listened to your talks and others, you kind of come away with the feeling of, unless somebody proves it's impossible to do something, then it probably is possible.
Right.
It's maybe hard. You don't know it, but that definitely has been the case with MEV. Early on, it seemed like an insurmountable, and now it seems pretty tractable.
So there is one kind of other technical solution, which I should maybe mention, which is try and make Ethereum a bit more like Bitcoin. So Bitcoin has this superpower, which is you can't do restaking. The best you can do is merge mining. And with merge mining, it's like carrot only, no sticks. You can get some rewards, but you can't slash the mining machines.
Right.
Now, it turns out that you can simulate proof of work, kind of carrot, no sticks, on proof of stake with one-shot signatures. Plus kind of a change to the withdrawal credentials. So right now, the withdrawal credentials, they're kind of this fixed thing that you can't change, they're immutable. But if they're updatable by the signing key, then whoever's the operator or the custodian of the staking key can change the withdrawal credentials and therefore change the slashing conditions to something else. And then the only other vector for slashing is in-protocol slashing, which you can also build a restaking service around. It's more difficult, but you still can do it. And their one-shot signatures remove this second vector. Now, part of the reason why I'm not totally optimistic on this is that there are kind of other ways of doing slashing off-chain with legal contracts, with SGX, with MPC stuff. So it wouldn't be totally trustless. And the question is, like, is it sufficiently trusted that it wouldn't work in practice? And maybe the answer is yes, in which case we actually have like this nuclear option of potentially removing staking, restaking from Ethereum.
I see. That's interesting. Yeah, I haven't heard you talk about that before, so that's definitely have not heard proof of work on proof of stake.
Yeah.
One thing about the this kind of conflict you were talking about between is the yield coming from like MEV versus it coming from like a restaking thing. I think part of maybe what makes me scared about if a restaking service like has a very high yield is that there's like a yield chasing inflow of ETH. And I think one of the core properties of Ethereum's consensus layer is that it's like very slow to enter and exit, right? Like it's very different from DeFi in that everything takes like a week or, you know, things happen over the day time frames. And that gives you more certainty around like the stability of the underlying consensus. Whereas if these yields aren't showing up in some like DeFi yield farm, but are instead showing up in like a restaking service, then you could see like a massive demand for an increase in stake and also stake to restake. And especially if you get liquid restaking tokens, which I think we all expect to happen. I want to say I heard them called LRTs, liquid restaking tokens, but I think that's worse than RSTs, which is restaking tokens. So that's my pitch for you all. So you could get into a position where, you know, especially if the yields are very high, one thing you see people do is like kind of try and lever up on those yields. Mm-hmm. So you restake some ETH, you get a liquid restaking token, you swap it on the lending market for ETH, you restake that, or for stETH probably, you restake that stETH and kind of like wind up a few times. And these whole situations have the kind of like death spiral effect where if there's a slight movement in the price of stETH, for example, like if stETH depegs by just a marginal amount, then you could have like a huge unwind of all these DeFi positions. Mm-hmm. And, you know, I don't think we know exactly what that would look like in terms of the consensus layer, but it would be like chaotic enough to be potentially scary.
Yeah, yeah.
It seems actually the consensus layer frictions are correctly designed. So it doesn't matter what happens on the upper layer. You cannot enter or exit more than the rates that are set. So it's not totally clear to me what the problem that you're envisioning there is.
But like if restaking creates an increased, like a very high increased demand for staking on the underlying layer, then there's like maybe a massive inflow of ETH, and then if all the yield gets eaten up, then there's massive outflow of ETH. And yeah, it is rate limited by the queues, like you said. But I think kind of it just seems to add a lot of instability to the validator set in a way that feels scary. I don't know. Am I making a mountain out of a molehill here?
I mean, one thing that the queuing does is actually it creates the perfect conditions for the social layer to intervene if something really bad happens. So if you look at the DAO, it just so happened that there was a 2-week window where the attacker could not extract the funds. And that makes it much more palatable to do a social intervention because you don't have to rewrite history. Like you just like change the state transition function. There's the so-called exceptional state transition change. And if something really, really bad happens with restaking, then the fact that we have this slow exit means that an attacker can't just exit everything in one go, and that gives time for the social layer to come in. Now, I don't know if it's actually a good thing or a bad thing, because on the one hand, it's good because now our ability to do bailouts is increased, but it's also bad because now, because we can do bailouts, we potentially lose on credible neutrality.
How many, just curious in the audience, might be helpful for the panelists up here? Raise your hand if you think it would take more, let's say, let's use 1 year as a threshold. And if everybody that was currently staking wanted to exit staking, who in the room thinks it would take less than a year? Or let's actually say, raise your hand if you think it would take more than a year for all of the stake on Ethereum to be withdrawn. Okay. And then how many people feel it's less? Just looking to see if we've got. Okay. All right. So like maybe about a fifth on each, and then the other 60% are uncommitted. What is the answer?
So it's a bit of a tricky question because, I mean, I think it's on the order of 3 months, something like that.
Mm-hmm.
Basically, the way that we designed the churn is so that it's proportional to the amount of stake. And so, you know, even in the early days, it felt like things were very, very slow. You know, there was these very long exit queues. Now the exit queue is empty, and part of the reason is because, you know, the validator set size has grown, and therefore the capacity has grown. And I think what we've tried to do is like to design the churn in such a way that the weak subjectivity period is on the order of months. Mm-hmm. And 3 months is what I have in mind, but you know, someone needs to do the calculation.
Yeah, actually, you're saying the answer. I've had a lot of people tell me if I ask them, even if they're knowledgeable, they just say, I'm not, you know, I know it's long, don't know exactly how long.
Yeah.
I know it shouldn't be less than, you know, a month and a half, 2 months, because that would be getting too dangerously short. But it's an interesting point, just because a lot of like fundamental issues about like lack of liquidity in pools and other stuff is so tied to it. I want to make sure, actually, I really appreciate, you know, optimism being on the panel here, and feel like a lot of the questions have not been totally appropriate, but let me just direct one specifically to you. So you're at a one, and optimism obviously is creating a massive kind of ecosystem around it with the super chain, you know, Coinbase making the decision to be there, not only is bringing a lot of kind of DeFi action, but also their commitment to do KYC, their commitment to like eventually exit the SEX, their centralized exchange, and be all on chain is there. Is it, you know, kind of a wait and see, or do you feel like, you know, restaking and using shared security is something that isn't going to be in the optimism, you know, system, and it's going to kind of be leveraged on? I don't actually know this for sure, but it's leveraged, you know, it's based on OP tokens, or, you know, what is expected to be, you know, the security mechanism?
Totally, that's a great question. I think, you know, I can't necessarily comment on like any particular roadmap, things like that.
Yeah.
But I definitely see a world in the future where, you know, we can't really stop anyone from restaking if they want to build a sequencer that, you know, utilizes restaking, right? Because once kind of like sequencing is opened up, then people will be able to, you know, utilize whatever technologies they want. What I do think is really interesting with restaking is kind of the concept of, say, restaking into an L2. Like, why can't you, at the same time, have a liquid staking token be, you know, deposited as like a validator and be deposited into an L2? And like, this is kind of like taking like, you know, liquid staking tokens to the next level. And I'm really curious if this sort of design will be able to outcompete traditional rollups that, you know, keep all of their assets 100% collateralized in the bridge. Because once you start rehypothecating the bridge, then, you know, things become much more risky when users want to withdraw from the L2. If the ether is instead, you know, staking with validators, then you know, users will only be able to withdraw a certain amount at a certain time. But the trade-off here is that the users on the L2 could be passed some of the yield, plus they could be passed any, you know, restaking-based yield just by depositing into the L2. So, yeah, I'm super curious to see what happens when somebody launches one of these for the first time. Okay.
Yeah, I mean, you are definitely doing a great job of making sure, you know, to not do the wrong thing, which is to talk about future plans, because it's kind of hard for you to not have some kind of knowledge, you know, because you're kind of on an inner envelope. But yeah, I mean, it sounds like what you're talking about is these are discussions happening on, you know, the kind of the DAO and the community and that sort of stuff. So it's kind of a public discussion that you're referring to here.
Totally.
And yeah, I mean, it's definitely, it's an interesting construction. It's, you know, complex. This is, you know, probably one of the most interesting things about the alignment is how many things are possible that can make it go well, and then how many things that people can do that are just potentially very bad ideas because you get a little bit more return. And, you know, on one of these investment risk return things, it's okay to get a little bit extra risk if you're getting enough extra return, but if you do a little bit of return, and then if you decide it's okay because you've externalized massive risks to the community, which is, you know, that's how I would categorize, you know, when, Justin, when you mentioned Vitalik worries about this implication back to layer one, is if layer one is externalized, it has the risk externalized to it, which any smart business person would do. They would just say, let me do that. Yeah, okay, good. That's kind of the main topics that I at least had on my list here. I don't know, you know, I mean, just sort of end it there. If anybody wants to make, you know, final comments or other things, I think you heard Justin make the comment of like there fundamentally is a lot of need around ideas like restaking for people to research it. I think without that, you know, just kind of building it and hoping it works out is not a great plan. I think we saw in the MEV community that was pretty successful. Tremendous amount of research was happening as in kind of adjunct to EF research. So for anybody who's here or people who are watching it, if you're on the research side, definitely get involved. I, you know, expect there's going to be a lot of kind of development and grants and other things explicitly around that. And yeah, maybe I'll kind of leave it at that. Always good to do a little hiring pitch.
Thank you.
Okay.
Thank you very much.
Yeah, thanks.
All right, thank you all.